This morning, four of the largest institutional banks in the world quietly halted all silver trading activity on their desks. No press releases. No CNBC headlines. Just silence. This was not a scheduled systems upgrade. It was not routine maintenance. It was a calculated decision driven by something far more serious. These banks, with billions in daily volume, pulled out because the risk models they have relied on for decades no longer work. They saw the math break. They saw the cracks forming in a system that has long masked physical shortages with layers of leveraged paper contract. And for the first time in over a generation, they blinked. Silver has always been a manipulated market. Most of us who have held real metal for years have known this. But something changed this week. When four major players simultaneously step back from a commodity they have helped control for decades, it is not a coincidence. It is a warning. A market based on confidence cannot survive when its biggest dealers walk away from the table. And now the illusion is breaking. This is not a theory. It is not speculation. It is happening in real time. If you already own physical silver, you're not crazy. You're early. If you've been watching from the sidelines waiting for a signal that the game has shifted, this is it. The paper charade is unraveling. What happens next will not be polite. For years, the paper-silver market has survived on trust and leverage rather than metal. And today that imbalance is no longer theoretical. According to publicly reported COMEX warehouse data, open interest in silver futures represents roughly 900 million ounces of contractual claims, while registered silver available for delivery sits near 38 million ounces. That means more than 20 claims exist for every single ounce of real silver. I want you to pause on that number, because this is not how a healthy commodity market functions. This is how confidence-based systems fail. Paper promises work only as long as no one asks for the real thing. The moment even a small percentage of contract holders demand physical delivery, the structure strains and then snaps. We have seen this pattern before in other commodity markets, and history shows that once delivery pressure appears, exchanges do not protect the investor, they protect the system. Cash settlement replaces metal. Contracts get rewritten. Price signals become meaningless. For anyone over 35 who remembers past financial crises, this should feel uncomfortably familiar. The danger is not volatility. The danger is insolvency hidden behind liquidity. Many investors assume that futures markets are backed ounce for ounce. They are not. They are built on rollover behavior and complacency. When confidence breaks, the paper market does not slowly adjust. It fails suddenly. This is why long-term holders of physical silver have always said the same thing. Paper is a claim. Metal is ownership. Right now, the numbers are telling a story that Wall Street will not discuss openly. Too many claims, too little metal, and a system that only works if no one calls the bluff. If you already hold physical silver, this moment is confirmation. If you are watching from the sidelines, understand this clearly. When delivery stress becomes public, the window closes fast. Earlier today, something happened that most financial media will not touch. Several major banks abruptly exited their silver trading positions. Not tomorrow. Not gradually. They stopped cold. Why? Because the numbers no longer add up. According to public COMEX data, if a bank holds a short position of 10 million ounces at $71 per ounce and physical silver spikes to 150, that bank is staring at a mark-to-market loss of $790 million. That is not theoretical. That is not a risk report scenario. That is math. And when those numbers crossed the screen in their risk departments, the decision was immediate. Step away from the table or face a catastrophic loss. The mainstream explanation will be mild. System upgrades, capital reallocation. But inside those institutions, the fear is real. The spread between the paper market and the physical market is widening fast. In Japan, silver bars are already changing hands for over $130, while COMEX clings to the illusion of 71. The banks know what that means. They know that if physical buyers stand for delivery, They will be forced to buy silver at any price just to cover their promises. That is not a trade. That is a trap. And the smartest players just walked away. If you have ever wondered when the game would change, this is your signal. This is not about speculation anymore. It is about survival. The institutions are protecting themselves. The question is, are you? Right now there are two silver markets, and they are no longer speaking the same language. On one side, you have the paper market, represented by COMEX, still quoting silver at around $71 an ounce. On the other side, you have the physical market, where real metal is bought, transported, and delivered. In Japan, verified reports have shown physical silver changing hands at prices as high as $130 per ounce. That is not a rounding error. That is nearly a $60 gap between the paper promise and the metal in your hand. For years, many of us who follow metals closely have suspected that the paper price was not telling the truth. Now the truth is telling on itself. This growing divergence means that the tether between supply and speculation has snapped. Arbitrage is failing. Delivery times are lengthening. Mints are reporting delays. And premiums on physical silver in Western markets are beginning to rise week by week. The longer this disconnect lasts, the harder it will be to close. And if it continues, one side of the market will break. Paper contracts only work when they can be redeemed or settled with confidence. But what happens when confidence disappears? What happens when the buyers no longer trust the quoted price? The answer is unfolding right now. The divergence between COMEX and physical silver is not an anomaly. It is a warning, a signal that the system built on leverage and illusion is running out of room to hide. If you have been holding physical metal, you are ahead of the curve. If you are still waiting, understand this. The longer you wait, the wider the gap will become. Across the physical silver supply chain, a silent panic is underway. Refineries in Switzerland are running 24 hours a day, pushing every ounce of capacity they have to meet an avalanche of demand. Industrial users from solar manufacturers to medical device producers are no longer operating on just-in-time inventory model. They are shifting to just-in-case. They are buying ahead. They are stockpiling. Because they see what is coming. They see delivery delays stretching from weeks into months. They see premiums rising across the board. They see reports of silver bars in Asia trading at double the COMEX price. And they understand that in a supply chain built on precision and timing, one missing material can bring entire operations to a halt. Silver is not optional in these industries. It is essential. And when something essential becomes scarce, the scramble begins. This is no longer about speculation. It is about survival, about keeping factory lines moving, about making sure your company does not get priced out of the raw material it needs to function. That urgency is now filtering into the retail side as well. Coin shops are reporting record volume. Online dealers are warning of backlogs. The United States Mint reported higher silver sales in the first month of this year than in the entire first quarter of last year. Everyone from large-scale industry to everyday savers is trying to get their hands on real metal. Not contracts, not promises. Silver dark to you and your bowl. The kind you can weigh. Because everyone senses the same thing. This is not a temporary squeeze. This is structural. And those who move first may be the only ones who get filled. There are only 3 ways this plays out. And if you have been watching the silver market closely, you already know which one is unfolding. The first scenario is a fantasy. It assumes the paper price of silver will suddenly surge to match the physical market. It assumes that the institutions shorting silver will willingly accept massive losses, and that regulators will stand by as prices double overnight. That is not going to happen. The second scenario is a hard default. In this case, COMEX simply runs out of deliverable silver. They declare force majeure and settle outstanding contracts in cash at a frozen paper price while physical silver continues to skyrocket. This has already happened before in other markets. In 2022, the London Metal Exchange canceled trades in nickel to protect certain participants. If this repeats in silver, the result is clear. Paper contracts lose all credibility. Physical metal becomes the only thing that matters. Prices for real silver could spike to $150 or even $300 per ounce, while COMEX quotes remain stuck in the past. That scenario is highly probable. But what we are witnessing right now is the third scenario in motion. A controlled retreat. Big banks are exiting quietly. Liquidity is drying up. Prices are beginning to move upward, but in a way that does not trigger panic. The system is buying time, stretching the unwind, trying to let the shorts escape before the dam breaks. This is not about market efficiency. It is about system preservation. But no matter which path we take, the conclusion is the same. Physical silver wins, paper silver loses. And the longer you wait, the harder it becomes to act without paying dearly. When the system starts to fracture, the smartest move is not to chase headlines, but to secure what cannot be reprinted or rehypothecated. That means physical silver, not ETFs, not mining stocks, not unallocated accounts promising redemption someday. If you do not hold it, you do not own it. This is not a slogan. It is a principle that separates those who survive systemic shocks from those who get wiped out by it. The recent actions of 4 major banks pulling out of the silver trade should not be ignored. It is a signal that risk models have failed and trust in the paper system is evaporated. The playbook now is simple. Accumulate physical silver with discipline and purpose. Do not panic buy. Instead, use dollar-cost averaging buy. Spread your purchase over time. Take advantage of moments when premiums are stable. Focus on what will be recognizable and tradable under stress. Start with government-minted coins like American Silver Eagles or Canadian Maples. Add silver bars for lower premiums and storage efficiency. Include some 90% junk silver for divisibility and barter potential. Do your due diligence. Only buy from trusted dealers. Check weights and certifications. And most importantly, store your silver somewhere secure and accessible. Not in a bank vault that may lock down during a crisis. Not in a digital vault that might be inaccessible when systems freeze. This strategy is not about getting rich quick. It is about protecting what you have worked for. The next phase of this market will punish complacency, but it will reward those who saw through the illusion and took action while time remained. This is not just a silver crisis. It is the early tremor of something much larger. Silver is the canary in the coal mine, and that canary is gasping for air. When the silver market breaks, it is not just about bullion or supply chains. It is about trust. It is about the fragility of a system that has substituted leverage for value and illusion for collateral. What we are watching is not isolated to silver. It is a signal that pressure is building beneath the entire financial structure. Gold will not remain untouched. Sovereign bonds, long considered safe havens, are now tied to nations drowning in debt and printing currency to stay afloat. Faith in fiat money is beginning to erode not just at the margins but at the center. The U.S. national debt has crossed $36 trillion. Interest payments alone now exceed $1 trillion per year. That is not a sustainable equation. The cracks are visible. They are spreading. And silver is simply the first asset to reveal what lies beneath. If you have been sensing that something feels off lately in the markets, you are not alone. This is not business as usual. This is a monetary regime change. The system built on promises and paper is approaching its limits. The question is whether you act while the window is still open. The advantage right now belongs to those who recognize that the real story is not about the price of silver, but about the end of an era. Those who move early will preserve wealth. Those who wait for confirmation will find it too late.